Rio Tinto's Pilbara iron ore operations generated $16.2 billion in underlying EBITDA during 2024. That's $44.4 million every single day, $1.85 million every single hour, or $30,833 every single minute. While you read this opening paragraph, these operations just produced iron ore worth approximately $154,000. This single region in Western Australia generates more annual earnings than the entire GDP of Iceland, Cyprus, or Cambodia, and it accomplishes this extraordinary feat by moving 328.6 million tons of red rock from the Australian Outback to steel mills across Asia. The scale of 328.6 million tons defies intuitive comprehension until you translate it into tangible comparisons. If you loaded that entire year's production into standard 20-ton dump trucks and parked them bumper to bumper, the convoy would stretch 164,000 kilometers, enough to circle Earth's equator 4.1 times, or reach nearly halfway to the moon. Stack it all into a single cube using iron ore's typical density of 3.5 tons per cubic meter, and you'd build a structure approximately 480 meters on each side, taller than the Empire State Building's roof height, wider than 4 football fields end to end, and made entirely of iron ore extracted, processed, transported, and shipped in just 365 days. But here's what makes this achievement truly extraordinary from a productivity standpoint. Rio Tinto achieves this 328.6 million ton output with approximately 10,000 direct employees across the Pilbara iron ore operations. That translates to 32,860 tons produced per employee annually, or roughly 90 tons per employee per working day. To visualize that daily productivity, each employee's work contributes to moving the equivalent of 4.5 full-size dump trucks, or 18 adult elephants, or 90,000 kilograms of material every single day. Compare that to historical underground mining operations from the early 20th century, where 500 miners might collectively produce 100,000 tons annually, about 200 tons per worker per year, and you begin to grasp how radically automation and technology have transformed the fundamental economics of resource extraction. The Pilbara region itself encompasses approximately 502,000 square kilometers of northwestern Western Australia, an area larger than Spain, roughly equal to California, and about twice the size of the United Kingdom. This vast expanse contains some of the oldest exposed rocks on Earth's surface, with certain formations dating back 3.6 billion years to the Archean Eon. The iron ore deposits themselves formed between 2.5 and 2.7 billion years ago through a remarkable geological process. When photosynthetic bacteria first began producing oxygen, that oxygen reacted with dissolved iron in Earth's ancient oceans, precipitating iron oxide that settled in layers on the ocean floor. Over billions of years, these layers were buried, compressed, uplifted, and eventually exposed at the surface, creating the massive banded iron formations that now supply global steelmaking. The profound irony of this geological history bears noting. What we now call pollution, the release of oxygen into Earth's atmosphere by early cyanobacteria, was actually the environmental catastrophe that created iron ore deposits. That ancient oxygen pollution precipitated dissolved iron from the oceans, creating the exact deposits that now enable modern industrial civilization. The steel in your car, the rebar in your building, the appliances in your home, all trace back to bacteria polluting Earth's atmosphere 2.7 billion years ago. Rio Tinto is essentially mining the byproduct of ancient environmental change to fuel contemporary economic development. Across this ancient landscape, Rio Tinto operates 18 separate iron ore mines, each a massive open-pit excavation, extracting ore from deposits that extend hundreds of meters below the surface. The mines bear names that mix Aboriginal languages, European exploration history, and mining company heritage: Tom Price, Paraburdoo, Yandikujina, Marandoo, Brockman 2, Brockman 2, Brockman 4, Namuldi, Hope Downs 1, Hope Downs 4, West Angeles, Silvergrass, Mesa A, Mesa J, Western Turner Syncline, Greater Brockman, Gudai-Darri, and the newest flagship operation, Gudai-Darri. Each mine represents billions of dollars in capital investment, years or decades of operational planning, extensive environmental permitting, and complex partnerships with indigenous traditional owners whose ancestors have lived on this land for over 30,000 years. These 18 mines collectively shipped 328.6 million tons of iron ore in 2024, though that figure represents a modest decrease of 1% compared to 2023's record 332.2 million tons. This decline wasn't driven by weakening demand or operational failures, but rather reflected deliberate production management responding to market conditions and natural mine life cycles. Rio Tinto actually achieved productivity improvements totaling 10 million tons in 2024 through operational excellence initiatives under their Safe Production System program. But these gains didn't fully offset natural ore depletion occurring at older operations like Yandi-Kujina and Paraburdoo, as the company executes the planned transition to newer replacement mines like Western Range and Gudai-Darri. Understanding ore depletion and mine replacement is absolutely critical to comprehending mining economics and Rio Tinto's long-term strategy. When you first begin extracting ore from a new deposit, you logically start with the easiest, highest grade, most accessible material near the surface. Year by year, as that material is removed, you must dig progressively deeper. The remaining ore grades may gradually decline. The ratio of waste rock to ore, called the strip ratio, tends to worsen, and extraction becomes increasingly complex and costly. Eventually, perhaps after 15 years, perhaps after 40 years depending on deposit size and extraction rates, you reach an economic endpoint where the remaining ore is too deep, too low grade, or too expensive to extract profitably at prevailing commodity prices. The mining industry's solution to this inexorable depletion is systematic replacement. You develop new mines while existing operations are still highly profitable, ensuring continuous production capacity even as individual mines exhaust. This is precisely the strategy Rio Tinto has executed in the Pilbara for nearly 60 years since first shipment in 1966. Tonne, the original line that launched Rio Tinto's Pilbara operations, remains productive today, but at reduced rates compared to its historical peak. Paraburdoo, commissioned in 1972, is now transitioning toward eventual closure as newer, larger deposits take over production volumes. This constant cycle of new mine development replacing depleted capacity is what enables Rio Tinto to maintain 320+ million tons of annual production decade after decade. Western Range exemplifies this replacement strategy. Scheduled for first ore production in the first half of 2025, Western Range will gradually ramp up to full capacity, while Yandi-Kujina and other depleting operations wind down, maintaining Rio Tinto's overall Pilbara production capacity around 340 million tons annually. Capital investment for Western Range and associated infrastructure, rail spurs, processing facilities, power supply, runs into billions of dollars, but it's absolutely essential infrastructure spending to maintain the production base that generates $16.2 billion in annual EBITDA. Without continuous replacement mine development, Rio Tinto's Pilbara production would inevitably decline as existing mines depleted, eroding the cash generation that funds dividends, sustains capital investment, and supports the company's global diversification strategy. Now let's break down with precision what that $16.2 billion in underlying EBITDA figure actually represents, because financial terminology matters and precision distinguishes informed analysis from hand-waving. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. In operational terms, it measures the cash earnings a business generates from core operations before accounting for capital structure decisions, interest, government taxation, and non-cash accounting charges, depreciation and amortization. For Rio Tinto's Pilbara iron ore business, That $16.2 billion EBITDA represents the purest measure of operational profitability and cash generation capability. Essentially, how much cash the mines, railways, and ports collectively generated in 2024 before any corporate overhead, financing costs, or accounting adjustments. To truly contextualize $16.2 billion in annual EBITDA, we need concrete comparisons that ground this abstract number in familiar references. That $16.2 billion exceeds the total annual GDP of countries including Paraguay, 45 billion GDP for a nation of 7 million people, Bolivia 43 billion, Cambodia 30 billion, or Iceland 28 billion. One mining region operated by one company generated earnings larger than the entire economic output of sovereign nations. It's more than double Starbucks' global operating income across 35,000 stores in 80 countries. It exceeds the total annual government budget of New Zealand, a developed nation of 5 million people. The Pilbara iron ore operation generates earnings comparable to running a medium-sized national economy, and it achieves this year after year with remarkable consistency. But we must distinguish EBITDA from revenue because confusing these metrics reflects fundamental misunderstanding of corporate finance. Rio Tinto's iron ore segment generated approximately $32.2 billion in total revenue during 2023, according to company financial reports. With 2024 shipments of 328.6 million tons at an average realized price around $110 per ton, accounting for product mix, pricing mechanisms, and market fluctuations throughout the year, total 2024 revenue for the iron ore segment likely approached $36 billion. That $16.2 billion EBITDA therefore represents roughly a 45% EBITDA margin, meaning for every dollar of iron ore revenue, Rio Tinto generated approximately 45 cents flowed through as operating earnings before interest, taxes, and non-cash charges. This margin is extraordinarily profitable by virtually any industry standard, comparable to luxury goods companies or dominant technology platforms, and reflects Rio Tinto's exceptional cost position in global iron ore supply. Those industry-leading margins stem directly and unavoidably from Rio Tinto's position at the absolute low end of the global iron ore cost curve, a critical concept in commodity economics. Rio Tinto's unit cost guidance for Pilbara operations in 2024 was $21.75 to $23.50 per ton on an FOB-free onboard basis. This represents the fully loaded cost to extract ore from the ground through blasting and excavation, load it into haul trucks, transport it to crushers and processing facilities, haul it via autonomous trucks to rail loading points, transport it up to 400 kilometers by autonomous train to port facilities, stockpile and blend it to customer specifications, and load it onto massive Capesize bulk carriers for export. Everything from explosives to diesel fuel to labor to maintenance to electricity, all captured in that $21.75 to $23.50 per ton figure. And a $22.50 average unit cost and a $110 average selling price, Rio Tinto generates a gross margin of $87.50 per ton before corporate overhead, exploration spending, and taxation, representing nearly 80% gross profit margin. This is extraordinary profitability, but the cost position's real strategic power emerges during price downturns. When iron ore prices fall below $90 per ton, as happened in September 2024, when prices briefly touched $91.28, marginal producers worldwide begin hemorrhaging cash, cutting production, laying off workers, or mothballing operations entirely. Rio Tinto at $91 per ton? Still generating approximately $68.50 per ton in gross margin. Still highly profitable, though obviously less spectacularly so than at $120 or $140 per ton prices. This cost resilience is Rio Tinto's fundamental competitive moat. They can remain profitable and continue operating at price levels that force higher-cost competitors to shut down. This cost advantage isn't accidental, lucky, or temporary. It's the compounding result of multiple structural advantages that competitors cannot easily replicate. Let's methodically unpack each factor, starting with raw geological fortune. The Pilbara's iron ore deposits naturally contain 62% to 65% iron content in the form of hematite, Fe2O3, among the highest natural grades available anywhere in global iron ore trade. For comparison, Brazil's Vale produces iron ore of comparable quality from 64–66% iron content. But many deposits in China, India, and other countries average 45 to 58% iron content. This difference isn't trivial, it's economically transformative. Higher ore grade means proportionally less waste rock must be removed to access ore, less processing is required to upgrade ore to shippable quality, transport costs per unit of contained iron are lower, and most importantly, customers pay premium prices because less of Rio Tinto's ore is required to produce each ton of steel. When a blast furnace operator in Tangshan, China receives Pilbara ore at 64% iron content versus Indian ore at 58% iron, they need approximately 10% less Pilbara ore to produce the same quantity of pig iron for steelmaking. This quality premium allows Pilbara producers to command prices roughly $3 to $8 per ton above lower-grade equivalents, even controlling for other factors. Over 328 million tons annually, that quality premium translates into roughly $2.5 billion in additional revenue from ore quality alone. Geographic proximity to Asian markets, particularly China, provides another structural cost advantage impossible for competitors to replicate. Western Australia sits approximately 7 to 14 days shipping time from major Chinese steel-producing cities, depending on exact route and vessel speed. Brazil's Vale, the world's second-largest iron ore exporter, ships from ports like Tubarão and Ponta de Madeira, requiring 30 to 45 days to reach Chinese ports. This 3–4 week shipping time differential translates directly into lower freight costs per ton for Pilbara producers, faster inventory turns for buyers, reduced working capital requirements, and superior supply chain responsiveness to demand fluctuations. When freight rates for Capesize vessels average $15,000 to $30,000 per day, those extra 20+ days of voyage time add $5 to $15 per ton in freight costs for Brazilian ore compared to Australian ore, a substantial competitive disadvantage. The infrastructure investment Rio Tinto has made over decades creates another nearly insurmountable barrier to entry. The company's Pilbara operations include nearly 1,900 kilometers of heavy-haul railway track. That's roughly equivalent to the straight-line distance from New York City to Denver, or from London to Sicily. This isn't a simple single-track railway, it's an integrated network of main lines, branches, spurs, and loops, connecting 18 separate mines to 4 port terminals at 2 coastal locations, Cape Lambert and Dampier, with sophisticated signaling systems, telecommunications infrastructure, maintenance facilities, and control systems, enabling the movement of hundreds of trains daily across this vast network. Building this railway network cost billions of dollars invested incrementally over 50+ years, and maintaining it requires hundreds of millions in annual capital expenditure for rail replacement, signaling upgrades, bridge maintenance, and telecommunication systems. The railway's operational scale staggers the imagination. Rio Tinto operates approximately 200 locomotives across the Pilbara network, hauling iron ore in trains that routinely stretch 2.4 kilometers from locomotive to last car, longer than 24 city blocks. A single loaded train carries approximately 28,000 tons of iron ore, equivalent to the weight of roughly 186 adult blue whales, or 560 loaded semi-trailer trucks, or 14,000 mid-size automobiles. These behemoths run continuously, 24 hours a day, 7 days a week, moving approximately 1 million tons of ore daily from remote mines to coastal ports. The logistical complexity of coordinating 200 locomotives, managing traffic across 1,900 kilometers of track, synchronizing with production from 18 mines, aligning with vessel arrivals at 4 port terminals, and maintaining 99% plus on-time performance without creating bottlenecks or costly idle capacity, represents a masterclass in industrial operations management. Now here's where Rio Tinto's infrastructure advantage transcends traditional industrial operations and enters the realm of technological revolution. Those 200 locomotives and hundreds of trains operate fully autonomously, without any human drivers aboard. AutoHaul, Rio Tinto's autonomous railway system, achieved full operational deployment across the entire Pilbara network in 2019, creating the world's first fully autonomous heavy-haul, long-distance railway network operating at commercial scale. This wasn't a small pilot project or limited trial. It was a complete transformation of how 1,900 kilometers of railway moves 1 million tons of ore daily. The system was developed through a decade-long partnership with Hitachi Rail, with Rio Tinto investing over $518 million in the initial AutoHaul deployment, plus additional hundreds of millions in subsequent years for network expansion, technology upgrades, and integration with new mines. AutoHaul trains are controlled entirely from Rio Tinto's Integrated Operations Center in Perth, located approximately 1,500 kilometers south of the Pilbara mining region, roughly equivalent to the distance from London to Rome or from Boston to Miami. Inside this state-of-the-art facility, specialized controllers monitor wall-sized displays showing real-time locations, speeds, system status, and operational parameters for every train across the network. They oversee onboard cameras providing live video feeds from locomotives, track GPS positioning, accurate to within 10 centimeters, supervise automated driving systems that control acceleration, braking, and speed with precision impossible for human drivers, and manage train routing across the network to optimize throughput. The trains automatically respond to track signals, speed restrictions, and traffic conditions without any human intervention in the cab, adjusting their driving profile continuously based on load weight, grade, curvature, and weather conditions to minimize energy consumption while maintaining schedule. The safety improvements from AutoHaul are substantial and measurable. Before autonomous operation, train crews worked 12-hour shifts, but a loaded train's round-trip journey from mine to port and back could extend up to 5-6 hours depending on specific route and loading-unloading times. This meant crews had to be transported by road vehicles to remote locations along the rail line for mid-journey crew changes, drivers finishing their 12-hour shifts being relieved by fresh crews who had been driven out from distant towns. These crew change road journeys collectively added approximately 1.5 million kilometers of driving annually across the network, with every kilometer representing safety risks from driver fatigue, wildlife collisions, kangaroos and cattle are common hazards, extreme weather, and the inherent dangers of remote outback driving at night. AutoHaul eliminated every single one of those 1.5 million annual kilometers of crew change driving, removing a significant source of safety incidents entirely from operations. The productivity and capacity gains from rail automation are equally impressive and financially material. Automated trains maintain more mathematically optimal speeds than human drivers, who naturally introduce variability in acceleration and braking based on individual judgment and experience. The AutoHaul system uses detailed topographic mapping of the entire rail network combined with real-time train weight and composition data to calculate the most energy-efficient driving profile for every section of track, accelerating at optimal rates, maintaining consistent speeds, and braking precisely when needed, rather than reacting to visual cues. This optimization improved average train speeds by approximately 6% across the network, without any physical track improvements or infrastructure changes, purely from better driving algorithms. Even more significantly, automation eliminated the need for trains to stop mid-journey for crew changes, directly adding productive capacity to the network. Previously, every crew change meant stopping a 28,000-ton train, potentially waiting for the relief crew vehicle to arrive if timing was imperfect, conducting safety briefings and handovers, and then accelerating back to line speed, collectively consuming 20 to 40 minutes per crew change. Multiply those delays across hundreds of trains weekly, and automation freed up the equivalent capacity of adding dozens of additional trains to the network without purchasing a single additional locomotive. Rio Tinto estimates AutoHaul-enabled system capacity to increase from 340 million tons annually to 360 million tons through pure operational efficiency gains. A 20 million ton capacity addition, worth $2+ billion annually at current iron ore prices, achieved through software and automation rather than multi-billion-dollar infrastructure expansion. Since the first fully autonomous loaded train departed Tom Price Mine for Cape Lambert Port in July 2018, the AutoHaul system has now traveled over 33 million kilometers in fully autonomous operation, equivalent to circling Earth's equator 825 times, or traveling to the moon and back 43 times. The system has achieved and maintained a mission success rate exceeding 98%, meaning 98% of autonomous train journeys arrive at their intended destination on schedule, even when minor incidents occur en route that might trigger automatic safety stops. That reliability is absolutely critical when you're moving 1 million tons daily through a just-in-time logistics chain where mines, railways, port stockpiles, and vessel loading must synchronize with minimal buffer inventory. Any extended rail network downtime cascades through the entire system, idling mines, building costly port stockpiles, and potentially causing ships to wait at anchor burning fuel while waiting for cargo. Now let's examine the mining operations themselves, because Rio Tinto hasn't just automated railways, they've systematically automated virtually the entire production chain from the first drill hole to the final loaded ship. At the 18 mines across the Pilbara, approximately 90% of the haul truck fleet now operates in fully autonomous mode, controlled remotely from Perth, rather than by drivers in the cab. These autonomous haul trucks aren't conventional vehicles, they're Komatsu 930E, and Caterpillar 794 ultra-heavy-duty mining trucks, each weighing approximately 500 tons empty, without payload, and capable of carrying 400-ton payloads of blasted iron ore from the pit floor to crushers or stockpiles. A 400-ton payload capacity is genuinely difficult to visualize without concrete comparisons. It's equivalent to the weight of approximately 57 fully loaded Ford F-150 pickup trucks, or 200 full-size grand pianos, or 80 adult male African elephants, or 2,000 average adult humans, all loaded onto a single truck for transport. These machines stand over 7.2 meters tall, about 2.5 stories, with tires measuring 4 meters in diameter, taller than a basketball hoop, and weighing 5 tons each. Under full load climbing a typical mine haul road grade, these trucks consume approximately 400 liters of diesel per operating hour, equivalent to draining a standard automobile's 60-liter fuel tank every 9 minutes. The capital cost to purchase and retrofit a single haul truck with full autonomous capability ranges from $5 million to $7 million per unit, depending on model and technology package. Rio Tinto currently operates more than 130 fully autonomous haul trucks across its Pilbara mine sites, representing over $650 million invested in autonomous haulage capability alone. The financial return on this massive capital investment is clear and measurable. Each autonomous truck operates an average of 700 to 1,000 additional hours annually, compared to crude trucks, which require shift changes, operator breaks, and time lost to variability in driver performance, while simultaneously delivering approximately 15% lower operating costs per ton, hauled through more consistent driving patterns, optimized routes, reduced maintenance costs from smoother operation, and elimination of driver-related labor costs. Over a 130-plus truck fleet operating 6,000-plus hours annually each, These productivity and cost improvements translate into tens of millions of additional tons moved and tens of millions of dollars in cost savings every single year. The autonomous trucks operate using a sophisticated combination of GPS navigation, accurate to centimeter-level precision, using differential GPS correction, onboard LiDAR and radar sensors for obstacle detection, and continuous wireless communication with a central control system that manages traffic flow across the mine site, like an air traffic controller. Each truck follows pre-programmed routes optimized through algorithms that consider factors, including haul distance, road grade, traffic density, and fuel efficiency. But the vehicles can and do deviate from routes automatically when sensors detect obstacles, other vehicles, or changing conditions. When a light vehicle driven by human maintenance workers or geologists approaches an autonomous truck, the truck's sensors automatically detect the approaching vehicle, calculate safe separation distances, and adjust speed or stop entirely to maintain safety margins that exceed human driver reaction capabilities. The safety record of autonomous haulage in Rio Tinto's Pilbara operations demonstrably exceeds that of human-driven fleets when measured by incidents per million tons hauled or per million kilometers traveled. Autonomous trucks don't experience fatigue during long shifts, don't get distracted by thoughts or conversations, don't experience judgment impairment from stress or medical conditions, and execute maneuvers with millisecond-level precision that humans cannot match. This superior safety performance wasn't immediately obvious when automation began. Skeptics questioned whether software could really navigate a chaotic, dusty, unpredictable mine environment more safely than experienced operators. A decade of operational data has conclusively answered that question. Yes, with proper system design and rigorous testing, autonomous trucks are measurably safer than human-driven equivalents. From the operations center in Perth, a single specialized controller can simultaneously supervise multiple autonomous trucks operating at different mine sites across the Pilbara, perhaps 4 trucks at Tonne, 3 at Paraburdoo, and 2 at Gudai-Darri, all from one workstation. The controller monitors integrated dashboards displaying each truck's location on the digital mine map, current payload weight measured by onboard sensors, fuel levels, system health status, and real-time productivity metrics, including tons hauled per hour and cycle times from loading to dumping and back. If any anomaly occurs, a mechanical fault sensor triggered, an obstacle detected on the haul road that the truck cannot automatically navigate around, or a deviation from expected performance patterns, the supervisory system immediately alerts the controller with visual and audio warnings. The controller can then assess the situation and, if needed, take manual remote control of the truck to guide it around the obstacle or direct it to a safe parking area for maintenance inspection. This centralized operations model represents not merely an incremental improvement, but a fundamental transformation in mining workforce structure and skills. Traditional mining operations required large populations of equipment, operators, truck drivers, and laborers working in remote, physically demanding, often harsh conditions, typically living in mining towns or camps for weeks at a time away from families. Modern automated mining concentrates technical expertise in comfortable, safe facilities. The Perth Operations Centre, where highly skilled technicians, engineers, and controllers manage equipment remotely. The total workforce is smaller by roughly 20–30% compared to fully crewed operations at equivalent production levels, but the average skill level, educational requirements, and compensation are meaningfully higher. This workforce transition creates social and political challenges in mining regions. Displaced operators who struggle to transition to new roles, concerns about reduced employment opportunities in regional communities. But from purely operational and economic perspectives, the productivity and safety benefits are undeniable. Rio Tinto's automation extends beyond trucks to drilling operations, which might seem like a minor technical detail, but is actually critical to overall mining productivity. The company operates the world's largest fleet of autonomous drills, with 40 autonomous blast hole drills deployed across 7 Pilbara mine sites. These machines create the precise patterns of vertical or angled holes drilled into hard rock, which are then filled with explosives to fragment the rock into sizes manageable for excavators and trucks. The quality of drilling, hole depth, spacing, angle accuracy, and consistency directly determines blasting efficiency, which in turn affects how easily excavators can load the blasted material, how much oversized rock must be rehandled, and ultimately, how many tons the mine can efficiently extract per day. Autonomous drills maintain significantly more consistent hole depth, precise spacing within centimeters, across patterns spanning hundreds of meters, and accurate angles compared to human-operated drills, where natural human variability introduces small deviations that compound across large blast patterns. The machines use ground-penetrating sensors to detect rock hardness variations and automatically adjust drilling parameters, rotation speed, downward pressure, percussion intensity for optimal penetration rates without damaging expensive drill bits. An autonomous drill can operate continuously for 2+ hours per day, except for scheduled drill bit changes and preventive maintenance, whereas human-operated drills require crew changes every 12 hours, with associated downtime for handovers and briefings. This productivity differential translates directly into more meters drilled per machine per month, which enables larger blast volumes, which enables higher ore production, all from automation of what might seem like a supporting process rather than core production. From the Perth Operations Centre, specialized drill controllers can remotely operate drills at Tom Price during morning hours, switch to managing drills at Paraburdoo in the afternoon, and supervise drills at Gudai-Darri in the evening, all without leaving their workstation, and certainly without driving hundreds of kilometers across the outback between mine sites. This operational flexibility allows Rio Tinto to concentrate scarce drilling expertise where it's most needed at any given time, rather than maintaining redundant specialists at every mine site. Geological data from drilling is transmitted in real time to Perth, where geologists can analyze the data, update their geological models of ore body characteristics, and adjust mine plans within hours, rather than waiting days or weeks for samples to be physically transported to laboratories, processed, assayed, and reported. The crown jewel and showcase of Rio Tinto's automation capabilities is Gudai-Darri, the company's newest and most technologically advanced iron ore mine, which achieved first ore production in 2022 after a $4.3 billion development program. Gudai-Darri was designed from inception as a fully autonomous mine of the future, with 0 crewed trucks planned for operations, 0 crewed drills, and minimal human presence on the mine site itself, except for maintenance workers, geologists, and supervisory personnel. The mine represents not just incremental automation of existing conventional designs, but rather a fundamental rethinking of what a modern mine should look like when automation is built in from day one, rather than retrofitted onto legacy operations. Gudai-Darri's automation extends to equipment types that aren't yet autonomous at other Rio Tinto mines. The mine features autonomous water trucks, specialized vehicles that spray water on haul roads to suppress dust for environmental compliance and safety, developed through an innovative partnership with Caterpillar. These water trucks use onboard artificial intelligence systems to navigate independently across the mine site, detect current road surface moisture conditions through sensors, and optimize water application rates in real time to minimize water consumption, a critical concern in the arid Pilbara while maintaining effective dust suppression. It's a seemingly minor innovation that represents another step toward fully autonomous mine sites, eliminating yet another human-operated vehicle category from the mining environment. Gudai-Darri also includes Rio Tinto's first robotic laboratory for automated ore sample processing and analysis. In traditional mining operations, geologists and technicians collect ore samples from drill cuttings and blast material, physically transport those samples, sometimes dozens of kilometers to a laboratory facility, and then manually prepare samples through crushing, grinding, splitting, and chemical analysis to determine iron content, silica levels, alumina content, and other critical ore quality parameters that determine market value and processing requirements. At Gudai-Darri, robotic systems handle the entire sample intake process. Automated crushing and preparation equipment processes samples to analytical standards, and automated analyzers conduct initial chemical characterization, with human geologists focusing their expertise on interpreting results and making operational decisions rather than spending time on routine manual laboratory work. This automation improves sample turnaround time from 24-48 hours to 4-6 hours, enabling much faster operational response to changing ore characteristics. Gudai-Darri incorporates a substantial 34-megawatt solar photovoltaic farm covering approximately 100 hectares of land adjacent to the mine site, one of the largest solar installations at any operating mine globally. While 34 megawatts of solar capacity cannot power the entire mine, the haul truck fleet alone consumes far more energy than that during peak operations. The solar farm supplies renewable electricity to mine processing facilities, administrative buildings, and accommodation camps, offsetting hundreds of thousands of liters of diesel fuel consumption annually and reducing greenhouse gas emissions by approximately 100,000 tons of CO2-equivalent per year. The solar farm also demonstrates Rio Tinto's genuine commitment to emissions reduction beyond mere public relations statements, representing a $60+ million capital investment with a purely environmental benefit rather than direct financial return at current diesel and electricity prices. At Gudai-Darri's planned full production capacity of 43 million tons annually, and assuming a conservative long-term average iron ore price around $110 per ton, the mine will generate approximately $4.73 billion in annual revenue. Against the $4.3 billion total development cost, including mine infrastructure, rail connection, power supply, and accommodation facilities, Gudai-Darri pays for its entire construction capital in less than 2 years of full capacity operation at current iron ore prices. Then it generates positive free cash flow for the remaining 8+ years of its expected 40+ year mine life. That's the fundamental economic power of world-class ore deposits in favorable jurisdictions. Enormous upfront capital requirements that would bankrupt smaller companies, but decades of highly profitable production that generate extraordinary cumulative returns far exceeding the initial investment. The infrastructure connecting these 18 mines to global markets is equally critical to the economic equation and deserves detailed examination. Rio Tinto operates 4 independent port terminals at 2 coastal locations, Cape Lambert, with 2 separate terminals, and Dampier, with 2 terminals, collectively capable of handling over 360 million tons of annual throughput. These aren't small coastal docks. They're industrial mega-facilities, featuring massive covered stockpile areas where ore from different mines is strategically blended to meet specific customer requirements. Ship loaders capable of loading 20,000+ tons per hour through gravity and conveyor systems, and deep water berths constructed to accommodate Capesize bulk carriers, the largest vessels in the ore-carrying fleet. A Capesize bulk carrier represents the largest category of ore-carrying vessels in commercial operation, typically measuring 280 to 300 meters in length, longer than 2.5 American football fields, 45 to 50 meters in beam width, and capable of carrying between 150,000 and 200,000 deadweight tons (DWT) of cargo. These vessels are so physically large that they cannot transit either the Panama Canal or the Suez Canal. Even when empty, they're too long for the locks, too wide for the canal channels, and far too deep when loaded to fit. Instead, Capesize vessels loaded with Pilbara iron ore, destined for Chinese steel mills, must voyage either northeast through Indonesian archipelago passages, or for some destinations south around Australia, and then north through the Philippine Sea, routing decisions driven by vessel draft, canal dimensions, and ocean current patterns. When one of these giants arrives at Cape Lambert or Dampier, and moors at a loading berth, Rio Tinto's automated shiploading systems can completely load 180,000 tons of ore in approximately 8 to 10 hours. The logistics of coordinating mine production rates, railway transport capacity, port stockpile inventory levels, and vessel loading schedules to achieve 328.6 million tons of annual shipments requires extraordinary operational sophistication and real-time decision-making. Rio Tinto's Integrated Operations Center in Perth manages this entire system: mines, railway network, port operations, as a single coordinated network rather than as independent silos. Mine production plans must align with rail network capacity and train availability. Train scheduling must synchronize with mine loading points and port offloading facilities. Port stockpile management must balance incoming rail deliveries with vessel loading requirements while maintaining proper ore blending to meet customer specifications. And vessel scheduling must coordinate with shipping companies, customers, and port capacity weeks or months in advance. One disruption anywhere in this system, a train derailment, a port equipment failure, a cyclone forcing port closure, ripples through the entire network, requiring dynamic replanning of production, logistics, and shipping. Now we must address the broader economic impact of these operations, which extends far beyond Rio Tinto's corporate financial statements and shareholder returns. The Pilbara region contributed approximately $37.8 billion to total economic activity in recent economic analyses, with mining and related support industries, collectively called METS, mining equipment, technology, and services, representing approximately 88% of the region's total economic output. To understand what this means, without iron ore mining, the Pilbara's economy would contract to roughly 1/8 its current size. The population would decline precipitously as workers departed for employment elsewhere. Towns like Tom Price, Paraburdoo, Karatha, Newman, and Port Hedland, currently supporting tens of thousands of residents with schools, hospitals, shopping centers, and community services, would shrink back to the small outback settlements they were before iron ore mining began in the 1960s, or potentially become ghost towns entirely. For Western Australia as a state, iron ore royalties collected from Rio Tinto, BHP, Fortescue, and smaller producers represent a truly massive revenue source funding state government operations. Western Australia charges approximately 7.5% of the value of iron ore extracted, calculated at the port, not the mine, as a production royalty. With Rio Tinto's 328.6 million tons worth approximately $36 billion in revenue, the company's Pilbara operations alone generated approximately $2.7 billion in royalty payments to the Western Australian government in 2024. Add BHP's roughly 285 million tons and Fortescue's 190 million tons, and total iron ore royalties collected by Western Australia exceed $12 billion annually at recent prices, representing roughly 1/3 of the state government's total annual revenue. These royalties directly fund Western Australian schools, hospitals, roads, railways, police, and every other state government service. When iron ore prices surge, the state government can fund new infrastructure and expand services. When prices crash, budget forecasts deteriorate, and difficult fiscal choices emerge. For Australia as a nation, iron ore stands as the single most valuable commodity export, dwarfing coal, natural gas, gold, and agricultural exports. Government forecasts from the Department of Industry, Science and Resources project iron ore will generate approximately $60 billion to $70 billion in annual export earnings for Australia in the MID-2020s. Specific figures vary year to year with prices and volumes. Iron ore alone accounts for approximately 15% to 20% of Australia's total merchandise export value, meaning $1 in every $5 or $6 Australia earns from exports comes from iron ore. This concentration creates both prosperity and vulnerability. When iron ore prices were strong in 2002-12022, Australia's trade balance surged into massive surplus. Government tax revenues exceeded expectations, and federal budgets returned to surplus for the first time in 15 years. When iron ore prices fell sharply in 2024, the trade surplus narrowed dramatically. Federal tax receipts declined, and budget forecasts required downward revision. The Australian federal government collects substantial corporate income tax from Rio Tinto's Australian profits, which flow primarily from Pilbara iron ore operations. In highly profitable years when iron ore prices exceeded $150 per tonne, Rio Tinto's Australian tax payments exceeded $5 billion annually. Even in more moderate price environments, with iron ore around $100 per tonne, the company pays several $billion in Australian corporate taxes, making it one of the federal government's largest single corporate taxpayers. Rio Tinto is also one of Australia's largest private sector employers when counting direct employees, contractors, suppliers, and service providers, whose businesses depend on mining activity. The wages, benefits, and local spending generated by this employment ripple through regional and national economies, creating multiplier effects where each direct mining job supports several additional jobs in services, retail, logistics, and other sectors. This creates complex economic dependencies and political dynamics. China consumes approximately 80% of Australia's seaborne iron ore exports, making Australia's economic prosperity partially dependent on Chinese steel demand, which is itself driven by Chinese infrastructure investment, real estate construction, manufacturing activity, and exports. When China's economy boomed during the 2000s and 2010s with GDP growth averaging 810% annually and massive urbanization driving steel-intensive construction, Australian iron ore miners expanded production capacity aggressively, mining towns flourished, government tax revenues soared, and resource company profits enabled extraordinary dividend payments to shareholders. When China's property sector entered severe crisis in the 2020s with major developers defaulting, construction slowing dramatically, and economic growth decelerating to 3–5% annually, iron ore demand plateaued or declined, prices fell sharply, and Australian government revenue projections had to be revised downward by tens of billions of dollars. Iron ore pricing dynamics merit deep analysis because price levels directly and immediately determine Rio Tinto's profitability, Australia's export revenues, government tax collections, and regional economic vitality. Iron ore trades globally as a bulk commodity with standardized pricing based on iron content, with the primary benchmark being 62%. Airy iron content fines delivered CFR cost and freight to major Chinese ports like Qingdao or Tianjin. Prices are quoted in US dollars per dry metric ton (DMT) and fluctuate daily, sometimes violently, based on supply expectations, demand indicators, port inventory levels, steel production rates, currency movements, and macroeconomic sentiment. Multiple price indices track iron ore including Platts Iodex, the Metal Bulletin, TSI, formerly the Steel Index, and ARTIS, with small variations between indices, creating arbitrage opportunities and hedging complexities. In 2024, iron ore prices demonstrated the commodity's inherent volatility and the challenges of forecasting in complex global markets. The year began with prices around $120 per tonne in early January 2024, reflecting reasonably tight supply-demand balance and decent Chinese steel production. By February, prices surged to approximately $144 per tonne, as Chinese steel mills aggressively restocked inventories following the Lunar New Year holiday shutdown, a seasonal pattern that recurs annually. Then economic reality reasserted itself. China's property crisis deepened with multiple major developers entering bankruptcy. Residential construction permits and starts declined further, and steel demand from the construction sector, which consumes roughly 50% of China's steel output, weakened substantially. By September 2024, iron ore prices had crashed to $91.28 per tonne, a two-year low representing a staggering 37% decline from the February peak just 7 months earlier. That price swing from $144 to $91 per tonne, a $53 per tonne decline, represents an absolutely enormous revenue differential for Rio Tinto's operations. At 328.6 million tons of annual shipments, a $53 per ton price change translates to approximately $17.4 billion in revenue variation, more than the entire annual GDP of Paraguay, Bolivia, or Cambodia. This is precisely why commodity mining is characterized as high-risk, high-reward. Operational efficiency and cost control matter enormously, but price volatility beyond any company's control can swing annual revenue and profitability by tens of billions of dollars. Companies that fail to maintain financial discipline during high price periods by assuming elevated prices will persist, taking on excessive debt to fund expansion, or paying unsustainable dividends, often face severe financial distress or bankruptcy when the inevitable price downturn arrives. What fundamentally drives iron ore prices? At the most basic level, it's steel production volumes, which are in turn driven by construction activity, residential and commercial buildings, infrastructure projects, manufacturing output, automobiles, machinery, appliances, and to a lesser extent military equipment and durable goods. In 2024, China's crude steel production totaled approximately 1.02 billion tons, accounting for over 50% of global production, but this represented a decline of approximately 2.7% compared to 2023, roughly 27 million fewer tons of steel, which required approximately 40 million fewer tons of iron ore, assuming typical blast furnace ore consumption ratios. But prices stabilized and partially recovered from that $91 low, trading in a range around $100 to $110 per ton through late 2024 and into early 2025. This price stabilization occurs because iron ore has a global cost curve, with marginal producers operating at roughly $70 to $90 per ton in cash costs depending on mine location, ore quality, transport distances, and operational efficiency. When prices fall toward $90 per ton, the highest cost producers begin shutting down because they're losing money on every ton mined and shipped. As these marginal suppliers exit the market, supply contracts and prices stabilize at levels where the marginal producer can just break even, creating a floor under prices absent a complete demand collapse. Current market dynamics suggest this marginal cost floor sits around $90 to $100 per ton, meaning prolonged prices below $90 would force meaningful supply closures that would eventually rebalance the market. This global cost curve dynamic is precisely why Rio Tinto's ultra-low cost position at $22.50 per ton provides such formidable competitive advantage and strategic resilience. At an iron ore price of $70 per ton, which would represent catastrophic market conditions and widespread industry distress, Rio Tinto would still generate approximately $47.50 per ton in gross margin before corporate overhead. Marginal producers would be bankrupt. High-cost producers would be hemorrhaging billions in losses. Medium-cost producers would be cutting production and laying off workers. Rio Tinto would still be profitable, still generating billions in cash flow, though obviously much less than at $110 per ton, still paying dividends, and positioning to acquire distressed assets from bankrupt competitors. This cost position enables Rio Tinto to maintain production through price downturns, capture market share from failing competitors, and emerge stronger when prices eventually recover. Rio Tinto's pricing and sales strategy involves sophisticated mechanisms to balance price exposure with revenue stability. Approximately 77% of Pilbara iron ore sales are priced based on the monthly average index price during the month of shipment, meaning if the Platts IODEX averaged $105 per ton during June 2024, shipments departing in June are priced at that $105 level, regardless of where prices trade in July or August. Another roughly 10% of sales are priced using the prior quarter's average index price lagged by 1 month, providing modest price protection but introducing temporal mismatches between market prices and realized revenues. The remainder of sales use current quarter average pricing, spot market pricing for opportunistic sales, or customized pricing mechanisms negotiated with strategic long-term customers. This diversified approach provides some natural averaging of price volatility while still allowing Rio Tinto to capture rising prices relatively quickly when markets strengthen. The company also sells iron ore using two different delivery terms that affect pricing and logistics responsibilities. Approximately 74% of sales are made on a CFR cost and freight, or CIF cost, insurance and freight basis, where Rio Tinto arranges ocean shipping from Pilbara ports to destination ports in China, Japan, Korea, or other markets, and the sales price includes both the ore value and freight costs. The remaining 26% of sales are made FOB free on board, where customers arrange their own shipping vessels, and Rio Tinto's responsibility ends when ore is loaded aboard the customer's vessel at the Pilbara port. CFR sales generate higher absolute revenue per ton, but include freight costs, while FOB sales show lower revenue but eliminate freight expenses and transfer logistics risk to customers. Examining profitability metrics provides additional insight into the exceptional economics of these operations. Rio Tinto's Pilbara iron ore business delivered an underlying FOB EBITDA margin of 67% in the first half of 2024, down slightly from 69% in the first half of 2023. For comparison, major technology companies like Apple or Microsoft achieve EBITDA margins in the 30–40% range. Luxury goods companies like LVMH or Hermes achieve 35–45%. Even global oil majors during strong pricing environments rarely exceed 50% EBITDA margins. Rio Tinto's Pilbara iron ore business at 67% EBITDA margin in a moderate pricing environment demonstrates the extraordinary cash generation power of world-class ore deposits operated with elite-level cost efficiency. Rio Tinto's capital expenditure requirements for the Pilbara remain substantial, even when operating in sustaining mode rather than major expansion. The company's total capital expenditure across all global operations was $7.1 billion in 2023, with Pilbara iron ore representing the single largest allocation. This capital spending includes sustaining capital to maintain existing operations, replacing worn-out equipment, maintaining rail infrastructure, upgrading port facilities, replacement capital to develop new mines like Western Range as older mines deplete, and modest growth capital for debottlenecking projects that incrementally increase production capacity. In the Pilbara specifically, Rio Tinto invests approximately $2 to $3 billion annually on sustaining and replacement capital, with amounts varying year to year depending on the timing of major rail upgrades, port expansions, or replacement mine developments. This massive ongoing capital requirement is simultaneously a barrier to entry. Competitors cannot easily replicate 60 years of accumulated infrastructure investment and a financial burden. Unlike technology companies with minimal capital requirements, mining requires continuous multi-billion-dollar reinvestment just to maintain production. Western Range mine development exemplifies these replacement capital dynamics and the financial discipline required in long-cycle mining investments. Scheduled for first ore production in the first half of 2025, Western Range will eventually ramp to approximately 25–30 million tons per year production capacity, replacing depleted capacity from Yandikujina and other aging operations. Against a $2.5 billion development cost, this represents payback in approximately 18 months of full capacity operation, assuming iron ore prices remain around current levels. If prices fall to $80 per ton, payback extends to several years. If prices rise to $140, payback accelerates to under 1 year. This price sensitivity explains why mining companies must maintain conservative balance sheets and financial flexibility to weather commodity cycles. A multi-billion-dollar investment decision made at $120 iron ore may face very different economics if prices average $90 during the mine's early years. Now let's examine competitive dynamics and Rio Tinto's market position relative to other major Pilbara iron ore producers, because understanding the competitive landscape provides critical context for strategic decision-making. BHP, the world's largest mining company by market capitalization and revenue, operates a competing Pilbara iron ore network through its Western Australia Iron Ore WIO division, producing approximately 255 to 285 million tons annually, depending on market conditions and production optimization. This oligopoly structure creates fascinating market dynamics and strategic considerations. When iron ore prices are strong at $120 plus per ton, all three companies benefit tremendously with massive profit margins, generous dividend payments, and financial capacity to invest in expansion or diversification. Moreover, Simandou carries geopolitical implications beyond pure economics. Rio Tinto holds a 45.05% stake in the Simandou project through joint ventures, but Chinese state-owned enterprises including China Baowu Steel, China Hongqiao, and China Railway Engineering Corporation also hold major stakes in different blocks of the project. For Australia and Rio Tinto, Simandou represents both an opportunity. Rio's stake provides exposure to new production, and a threat, reduced pricing power and geopolitical leverage. Other developing economies like Vietnam, Indonesia, or African nations will increase steel consumption as they develop, but the incremental tonnage pales compared to China's massive base demand. Battery electric locomotives for the rail network offer similar potential for cost reduction and emissions improvement. Continued automation of drilling, loading, processing, and port operations progressively reduces labor costs and improves consistency. Each incremental cost reduction, whether 50 cents per ton or $2 per ton, extends the price level at which Pilbara operations remain profitable, providing resilience against long-term price decline scenarios. Rio Tinto operates primarily using fly-in, fly-out FIFO workforce arrangements, where employees live in company-provided mining camps during work rotations, typically 8 days on, 6 days off, or 2 weeks on, 1 week off, or similar schedules, then fly home to Perth, regional centers, or even interstate cities during time off. This allows workers to maintain normal family homes in locations of their choosing rather than relocating to remote mining towns, and provides companies with workforce flexibility to scale up or down without community housing constraints. FIFO has clear advantages. Workers earn high salaries, often exceeding $120,000 to $180,000 annually for operators and technicians. Companies avoid the massive costs of building and maintaining entire towns in remote locations, including schools, hospitals, shopping centers, recreational facilities, and workforce recruitment improves, because people can live wherever they want while working in the Pilbara. But FIFO also creates substantial problems. Workers spend extended periods separated from families, creating relationship stress and mental health challenges. Fatigue risks increase from compressed work schedules and long working days, and regional communities that do exist near mining operations miss out on economic multiplier effects because workers don't live locally to spend wages on local businesses, send children to local schools, or participate in local civic life. The mining industry's transition from residential communities to FIFO has hollowed out some Pilbara towns, creating economic challenges for local businesses and reducing social cohesion. Looking toward the future, Rio Tinto's Pilbara operations face both genuine opportunities for continued prosperity and serious challenges requiring strategic navigation. On the opportunity side, India's steel consumption continues growing at 5–6% annually, as that nation of 1.4 billion people industrializes, urbanizes, and builds infrastructure, supporting economic development. While India possesses substantial domestic iron ore resources, growing demand may eventually require imports to supplement local supply, potentially creating new demand for Pilbara ore. Global infrastructure spending to support decarbonization, building renewable energy generation, upgrading electrical grids, constructing electric vehicle charging networks, replacing fossil fuel infrastructure, requires enormous quantities of steel and copper, supporting continued commodity demand even as traditional construction-driven demand plateaus. Technological advances promise further cost reductions and efficiency improvements through the late 2020s and 2030s. Fully autonomous zero-emission haul trucks, powered by battery electric drivetrains, could enter commercial operation by 2027-2029, based on current development timelines, eliminating hundreds of millions in annual diesel costs while improving productivity. Battery electric locomotives for the rail network may follow by the early 2030s, offering similar cost and environmental benefits. Artificial intelligence optimization of blast designs, autonomous truck routing, rail scheduling, processing plant operations, and port logistics could extract further productivity gains from existing assets. The technology frontier in mining continues advancing, and Rio Tinto maintains leadership positions in automation and digital innovation that should enable continued efficiency improvements. On the challenge side, the Simandou supply wave arriving over 2025-2030 will test whether the market can absorb an additional 100+ million tons without significant price declines. China's steel demand plateau or potential decline as the economy matures and becomes less steel-intensive creates headwinds for volume growth. Climate regulations, including potential carbon border adjustment mechanisms, may impose costs on high-emission steel, affecting demand for traditional blast furnace iron ore versus alternative iron production methods. Geopolitical tensions between Australia and China create political risks to trade, though both countries have strong economic incentives to maintain commercial relationships despite diplomatic friction. Social and environmental expectations continue rising, requiring more extensive consultation, stronger heritage protections, greater environmental performance, and increased investment in sustainability initiatives, with uncertain financial returns. The financial community watches these dynamics closely through research reports, investor presentations, and valuation models attempting to forecast Rio Tinto's long-term earnings and appropriate stock price. Analysts construct detailed models projecting iron ore prices under various scenarios, bears assuming $70 to $80 long-term prices based on supply growth and demand stagnation, bulls assuming $100 to $110 sustained by disciplined supply management and steady demand, and calculate resulting implications for Rio Tinto's earnings, free cash flow, dividend capacity, and intrinsic value. Debates about dividend sustainability, optimal capital allocation between sustaining operations versus growth investments, and management execution quality all factor into investment decisions and stock price movements. Rio Tinto paid approximately $5.2 billion in dividends during 2024, representing an attractive dividend yield of roughly 4 to 5% depending on stock price fluctuations, making it a favored holding for income-focused investors, including pension funds, retirees, and dividend-oriented mutual funds. That $5.2 billion dividend payout depends fundamentally on Pilbara cash generation. If iron ore prices structurally decline and margins compress significantly, dividends face pressure and potential reduction. Conversely, if steel demand surprises positively or Simandou delays substantially, Rio Tinto could maintain or increase payouts. The range of possible futures is genuinely wide, and forecasting commodity markets 5 or 10 years forward is notoriously difficult given the multiple variables affecting supply and demand. Rio Tinto's market capitalization fluctuates between approximately $100 billion and $150 billion, depending on commodity prices, market sentiment, and macroeconomic conditions. With iron ore contributing roughly 60% to 70% of company-wide earnings varying year to year, with commodity price movements and production from other divisions, Pilbara operations effectively underpin $60 billion to $90 billion in market value. An enormous financial stake riding on 328 million tons of annual iron ore production from one remote region. This concentration creates both opportunity, massive profits when conditions align favorably, and vulnerability, earnings collapse when iron ore prices crash. In concluding this comprehensive analysis, Rio Tinto's Pilbara iron ore operations represent one of the modern world's great industrial achievements, a masterclass in mining economics, operations management, technological innovation, and financial discipline that has created a $16.2 billion annual EBITDA business from desert iron ore deposits. The combination of exceptional geology, 62-65% iron content, strategic geography, 714 days from Asian markets, massive infrastructure investment, 1,900 kilometers of autonomous railway, 18 mines, 4 ports, relentless automation, 90% autonomous trucks, autonomous trains, autonomous drills, and operational excellence has created the world's most profitable iron ore business, generating earnings comparable to medium-sized national economies. The scale defies easy comprehension. 328.6 million tons shipped annually, $44.4 million generated daily, 1 million tons moving through the logistics chain every 24 hours, 200 autonomous locomotives hauling 2.4-kilometer trains, 130 plus autonomous trucks each carrying 400-ton payloads, 10,000 employees producing 90 tons per person per day. These aren't just impressive numbers, they represent fundamental transformation of how humans extract resources from Earth at scale, enabled by robotics, artificial intelligence, GPS navigation, wireless communications, and optimization algorithms that didn't exist when Tom Price Mine first shipped ore in 1966. Yet, this achievement exists within larger contexts that complicate simple narratives of technological progress. Environmentally, the operations consume scarce water, generate greenhouse gases, create permanent landscape alteration, and contribute to global steel production's massive carbon footprint. Socially, mining disrupts lands with 30,000 years of continuous indigenous occupation, creates employment while displacing traditional communities, and occasionally fails catastrophically in protecting irreplaceable cultural heritage, as Juukan Gorge demonstrated. Economically, the operations underpin Australian prosperity while creating dependencies on Chinese steel demand and exposing the nation to commodity price volatility. Financially, they generate extraordinary shareholder returns while facing long-term challenges from new supply, plateauing demand, and potential climate policies affecting steel markets. The Pilbara's iron ore reserves will eventually deplete, perhaps in 50 years at current extraction rates, perhaps 80 years. If production slows, perhaps 30 years if aggressive expansion occurs. Technologies may emerge enabling steel production from ore, without coal, transforming demand characteristics and competitive dynamics. Or global infrastructure investment may sustain steel consumption for generations, maintaining demand for Pilbara ore far beyond current forecasts. Commodity markets are fundamentally unpredictable over multi-decade timeframes, with too many variables, too much uncertainty, too many potential technological or political disruptions to forecast confidently. What we can assert with absolute confidence, right now today, Rio Tinto's Pilbara operations are extracting $16.2 billion in annual EBITDA from Western Australia's ancient red rocks. Autonomous trains are transporting ore from remote mines to coastal ports as you finish reading this analysis. Ships are loading 180,000 tons for voyages to Chinese steel mills. Those steel mills are converting Pilbara ore into construction beams for Shanghai towers, rebar for Jakarta bridges, sheet steel for Vietnamese appliances. The system is operating, profitable, technologically sophisticated, and economically central to modern industrial civilization. One autonomous train load at a time, generating $44 million daily from rocks that formed 2.7 billion years ago when bacteria first polluted Earth's atmosphere with oxygen.